January 2005. Two neighbors in a suburb outside Atlanta, Georgia. Both are 32 years old, both earned $55,000 a year, both have $50,000 saved. They are standing in the same economy, at the same starting line with the same amount of money. The only difference is what they do next. Daniel Reeves takes his $50,000 and puts a 20% down payment on a $250,000 three-bedroom rental property. He takes out a 30-year fixed mortgage at 5.8%. His monthly payment is $1,470. He finds a tenant paying $1,700 a month. On paper, $230 a month in positive cash flow before expenses. Daniel tells his wife this is the smartest thing they have ever done. Ryan Calloway takes the same $50,000 and puts it into a Vanguard total stock market index fund. He sets up an automatic investment of $300 per month from his checking account. He does not pick stocks. He does not watch CNBC. He checks his balance once a quarter, shrugs, and goes back to his life. Nobody at work asks him about it because nobody thinks index funds are interesting. On day one, Daniel has a house, a tenant, and a story to tell at dinner parties. Ryan has a brokerage account and a confirmation email. It is not close in terms of how it feels. But here is what I have learned going through nearly a century of data on both of these asset classes. Feelings and math are two completely different things. And the math on this debate has a twist that almost nobody talks about honestly. My name is Ban. I have spent 4 weeks going through Aswath Damodaran's annual returns database at NYU Stern, the Federal Reserve Bank of San Francisco's landmark study called The Rates of Return on Everything, 1870 to 2015, the Case-Shiller U.S. National Home Price Index, and the Vanguard How America Saves report from 2025. I am going to run Daniel and Ryan through every major economic event from 2005 to 2026, not with estimated returns, not with averages, but with the actual documented numbers for each year. And I am going to show you something that will change how you think about this debate permanently. But first, I need to introduce you to the one study that should have ended this argument years ago, and the reason it did not. I call this the Real Wealth Scoreboard. It comes from a paper called The Rate of Return on Everything, 1870 to 2015, published by the Federal Reserve Bank of San Francisco. The lead authors were Oscar Jorda from UC Davis and the Fed, Katharina Noll from the Deutsche Bundesbank, and Moritz Schullerich from the University of Bonn. They collected 145 years of total return data across 16 advanced economies, covering stocks, housing, bonds, and bills. This is the largest and most comprehensive return comparison ever assembled for these asset classes. Here is what they found, and this is the part that surprises almost everyone. Across 145 years and 16 countries, residential real estate and equities delivered nearly identical total returns. Housing averaged just over 7% per year in real terms when you include rental income. Equities averaged just under 7%. The returns were almost the same, but the risk was completely different. Housing returns had dramatically lower volatility. The standard deviation for housing was less than half that of equities. In plain language, real estate gave you roughly the same return as stocks with roughly half the stomach-churning drops. Now here is why this study did not settle the debate. Most comparisons you see online, including the Damodaran dataset I mentioned at the start, only count housing price appreciation. They leave out rental income entirely. When Damodaran shows real estate returning 4.3% per year, that is price only, no rent. That's like measuring stock returns without counting dividends. You would never do that with stocks, but almost everyone does it with real estate. When the Jorda study adds rent and income back in, real estate jumps from mediocre to competitive with equities. That single omission is the reason this debate has been so misleading for decades. And there's another factor that almost nobody includes honestly: tax advantages. Real estate investors can deduct something called depreciation from their taxable income. Here's how it works. The IRS lets you depreciate a residential rental property over 27.5 years, even if the property is actually going up in value. On a $250,000 property where the building is worth $200,000 and the land is worth $50,000, you can deduct approximately $7,272 per year from your taxable rental income. That is a legal tax shelter that stock investors simply do not have access to outside of retirement accounts. Combined with the mortgage interest deduction and the ability to use 1031 exchanges to defer capital gains indefinitely, real estate has a tax framework that was essentially designed by Congress to reward property ownership. Stocks offer long-term capital gains rates and tax loss harvesting, but nothing as structurally favorable as depreciation on an appreciating asset. But competitive does not mean identical, and it definitely does not mean that both investments work the same way for the same person in the same situation. So let me run the actual scoreboard for Daniel and Ryan. Let us start with the first 3 years, 2005 through 2007. This was the peak of the housing bubble. Daniel's rental property in suburban Atlanta appreciated roughly 8 to 12% per year during this period. His $250,000 house was worth around $310,000 by the end of 2007. He was collecting rent every month, covering his mortgage, and building equity. His total equity position was roughly $110,000. He felt like a genius. Ryan's index fund returned 4.9% in 2005, 15.8% in 2006, and 5.5% in 2007. His $50,000 had grown to about $72,000, plus his monthly contributions of $3,600 per year added another $10,800. Total portfolio, roughly $83,000. Solid, but not exciting. Daniel was ahead. Then 2008 hit. The S&P 500 fell 37%. Ryan's portfolio dropped from about $93,000 to roughly $63,000 in 12 months. He watched $30,000 disappear from his screen. He did not sell, but he did not sleep well for about 6 months. Daniel's situation was worse, but it did not feel worse immediately because real estate does not show you a daily price. Nobody sends you an app notification at 2 p.m. saying your house just lost 4%. The Case-Shiller Index for Atlanta fell roughly 28% between 2007 and 2011. His $310,000 property was now worth about $223,000. He still owed about $225,000 on his mortgage. He was underwater. His equity, the number he used to feel wealthy, was now negative $2,000. And his tenant lost her job in March 2009 and stopped paying rent. This is the part that no real estate guru on YouTube ever talks about. Daniel still owed $1,470 per month to the bank. The bank did not care that his tenant was not paying. The mortgage payment was due on the first of every month regardless. For 4 months, Daniel paid his own mortgage and his rental property's mortgage simultaneously. That's an extra $5,880 straight from his savings. Then he spent $3,800 in legal fees to complete the eviction in Georgia. He then spent $2,100 repairing damage, cleaning, and relisting. The property sat empty for 7 weeks before he found a new tenant, this time at only $1,500 a month because the rental market had softened. In the 18 months between September 2008 and March 2010, Daniel's total out-of-pocket emergency spending on his rental property was approximately $11,000. That's money he pulled from his savings, not from cash flow. Ryan's total out-of-pocket cost during the same period was $0. He just kept his $300 monthly auto investment running. In fact, every dollar he invested during 2008 and 2009 bought shares at deeply discounted prices. Those shares, purchased during the crash, would go on to more than quadruple over the next 15 years. Now, here is where the pattern gets strange. From 2009 to 2019, the S&P 500 had one of the greatest bull runs in history. It returned 26.5% in 2009, 32.4% in 2013, 31.5% in 2019. Over that 11-year stretch, the annualized total return was approximately 13.4% per year. Ryan's portfolio compounded aggressively. By the end of 2019, his account had grown to roughly $270,000. He had contributed a total of $103,800 in cash. The rest was pure compound growth. Daniel's property recovered. Atlanta real estate bottomed around 2012 and then grew steadily. By the end of 2019, his house was worth approximately $330,000. His remaining mortgage balance was about $165,000. Equity, roughly $165,000. He had been collecting rent the entire time, averaging about $1,700 per month for 14 years. That's roughly $285,000 in gross rent collected. But his total costs over those same 14 years were substantial. Mortgage interest, property taxes at about $3,000 per year, insurance at $1,500, maintenance averaging $4,000 per year, one full roof replacement at $9,200, 2 tenant turnovers with vacancy and relisting costs, the 2009 eviction and repair, and the opportunity cost of hundreds of hours managing the property himself. After subtracting everything, his net cash flow over 14 years was somewhere between $20,000 and $40,000 above his mortgage payments. That is real money, but it is not the fortune that the gross rent number suggests. At the end of 2019, 14 years in, the scoreboard looked like this. Ryan had roughly $270,000 in liquid, diversified assets with 0 hours of management. Daniel had roughly $165,000 in equity locked inside a single illiquid asset in a single zip code, plus $20,000 to $40,000 in accumulated net cash flow. Ryan was ahead by roughly $65,000 to $85,000, and he had not spent a single weekend fixing anything. But Daniel had something Ryan could not replicate: leverage. He used $50,000 of his own money to control a $250,000 asset. That is 5-to-1 leverage. When the property appreciated, his return on invested capital was amplified. Ryan used $50,000 to control $50,000. No leverage. This is the fundamental advantage of real estate, and it is the reason surveys consistently show real estate creating more self-reported millionaires than the stock market. Leverage makes winners win bigger. It also makes losers lose harder. Ask anyone who was underwater in 2009. Then 2020 hit. The S&P 500 crashed 34% in 23 days. Ryan's portfolio dropped from about $290,000 to $191,000. Then it recovered everything and closed the year up 18.4%. His portfolio ended 2020 at roughly $315,000. Daniel's rental property barely flinched in price. Housing held steady through COVID, and by 2021, it was exploding. Nationwide, the Case-Shiller Index showed a 19% annual increase, the fastest pace in the index's 35-year history. In Atlanta specifically, prices surged even faster. His property went from about $340,000 to over $400,000 in a single year. Daniel refinanced at 2.9%, dropping his monthly payment by over $300 and freeing up cash flow he had not seen since the pre-crash days. Daniel's equity was now over $250,000. For the first time in 15 years, Daniel was within striking distance of Ryan's total. Then 2022 happened. The S&P 500 fell 18.1%. Ryan's portfolio pulled back to about $330,000. Meanwhile, mortgage rates spiked above 7%, cooling the housing market. Daniel's property flattened at about $410,000, and here is where the scoreboard started doing something unexpected. In 2023, the S&P roared back 26.3%. In 2024, another 25%. Ryan's portfolio, with 2 decades of compounding and steady contributions, exploded past $500,000. By early 2026, including his continued $300 monthly contributions, Ryan's portfolio sits at approximately $545,000. His total cash invested over 21 years is roughly $125,000. The other $420,000 is compound growth, money that made money that made money. Daniel's property in 2026 is worth approximately $440,000 based on Atlanta Metro appreciation data. His mortgage balance is about $115,000. Equity, $325,000. Adding his net accumulated cash flow of roughly $50,000 to $70,000 over 21 years, Daniel's total real estate wealth is approximately $375,000 to $395,000. The final scoreboard at year 21. Ryan, $545,000. Daniel, $375,000 to $395,000. Difference, roughly $150,000. Ryan wins. But I want to be honest about something. This is what the documented record shows for these specific conditions. It is not financial advice, and it is not the full picture for every person in every market. Because here is where Daniel could have won. And this is the part most stock market advocates deliberately leave out. If Daniel had bought in a market with a stronger rent-to-price ratio, say Indianapolis or Memphis, where monthly rent runs at 1% or more of the purchase price, his cash flow would have been dramatically higher. If Daniel had taken that cash flow and invested it into an index fund every month, he would have had both the leverage of real estate and the compounding of stocks running simultaneously. If Daniel had used a 1031 exchange to roll his equity into a larger property after year 10, deferring capital gains entirely, his equity position would have compounded tax-free in a way stock investors cannot replicate outside retirement accounts. And if Ryan had panicked and sold during the 2008 crash or the 2020 crash or the 2022 pullback, he would have locked in his losses and missed the recovery. The data shows most retail investors do exactly this. Studies from Dalbar Inc., which has been measuring investor behavior since 1994, consistently show that the average equity fund investor earns roughly 3 to 4 percentage points less than the fund itself because of poorly timed buying and selling. Over 20 years, that gap is devastating. If the S&P 500 returned 9.9% and the average investor earned 6.5% because they sold during dips and bought back after recoveries, the difference on a $100,000 investment over 20 years is approximately $250,000. That is not a rounding error. That is the cost of emotion. Ryan's returns in my scenario assume he never touched the money. Most real people do not have that discipline. And that is the single strongest argument for real estate. You cannot panic sell a house at 2 a.m. because you saw a scary headline. The illiquidity that makes real estate inconvenient is also the mechanism that prevents the most common and most expensive investor mistake. The Jordan study found that real estate and stocks delivered nearly identical long-term returns across 145 years. But stocks delivered those returns with twice the volatility. That volatility is not just a number. It is the mechanism that causes real people to make real mistakes. If you can sit through a 37% crash without selling, stocks win. If you cannot, real estate's slower, steadier, less visible returns may actually produce more wealth view in practice, even if they produce less on a spreadsheet. Here is the number most people never calculate. Daniel spent roughly 500 hours over 21 years managing his rental property. If he values his time at $30 an hour, that's $15,000 in unpaid labor. If he values it at $50 an hour, which is closer to what a 32-year-old professional's free time is worth, that's $25,000. Ryan spent roughly 21 hours over 21 years, about an hour each year rebalancing and checking his account. The time cost difference is not small. It is a second job that Daniel worked for free. Here is what 97 years of Demidaren's data, 145 years of the Jordan study, and 21 years of Daniel and Ryan tell us. Stocks win on raw compounding over long periods, but only if you never sell during a crash. Real estate wins on leverage and stability, but only if you manage it properly and account for every real cost. The person who did both, who took rental cash flow and invested it in index funds, who used leverage on real estate and compounding on stocks, who treated real estate like a business and stocks like a savings account, that person beat both Daniel and Ryan by a wide margin. The answer was never real estate or stocks. The answer was always both, deployed correctly for your specific situation. But here is the single most important thing I found in all of this data. The number one predictor of whether someone built wealth over 20 years was not which asset class they chose. It was whether they stayed invested through the downturns. The people who cashed out their 401k when they changed jobs at 35, the people who panic sold their stocks in 2008, the people who walked away from an underwater rental in 2009. Those are the people who ended up with nothing regardless of which asset they picked. Daniel and Ryan both built wealth. They did it differently. They experienced it differently. Daniel has a physical asset he can drive past, a property that survived the worst financial crisis since the Great Depression and came out the other side worth more than he paid. He has rental income he can touch. He has tax deductions Ryan will never have access to. And he has the knowledge that he built something tangible with his own decisions. Ryan has $500,000 in a portfolio he barely thinks about. He has complete liquidity, meaning he could convert his entire position to cash in under 60 seconds on any business day. He has exposure to over 4,000 American companies instead of a single house in a single zip code. He has never received a phone call at midnight about a broken pipe. He has never written a $5,000 check he was not expecting. And he has 2 decades of undisturbed weekends. They both stayed in, and that is the variable that matters more than anything on any scoreboard. The Damodaran database is updated every January at the NYU Stern website. It is free and public and covers every major asset class going back to 1928. The Jorda study is available for free at the Federal Reserve Bank of San Francisco. It covers 145 years across 16 countries and remains the most comprehensive return comparison ever published. The Case-Shiller Index publishes monthly at fred.stlouisfed.org. You now have the 3 sources that contain the real data on this debate. Most people will never look at any of them. Now you know where to find them. The next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? The rent, the dividends, the maintenance, the volatility, the leverage, the taxes, the time. Because the answer that includes everything is the only answer that has ever mattered. This is Ban. Stay sharp out there.